Welcome to ACCA Financial Accounting, Topic A3, the Regulatory Framework. This lecture is all about who makes the rules behind every IFRS standard you'll ever study. Get this right, and everything else in FA clicks into place. This topic comes up almost every sitting, typically 2 to 4 marks, usually in Section A as MCQs. This is a conceptual topic. No single standard owns it, though IS 8 does make a cameo when we talk about filling gaps. Difficulty is level 1, so the examiner expects you to know definitions and structures cold. Expect 2 to 4 marks, often a couple of MCQs testing whether you can tell apart the ISB from the IFRS foundation. Right, let's start with the big picture. Section 1. Who makes the rules, and why that actually matters to you as a preparer. Before we dive in, think of IFRS as a skyscraper. The individual standards, IFRS 15 for revenue, IS 16 for property, plant, and equipment, those are the floors. But what we're looking at in this topic is the foundation and the architecture underneath. If you don't understand that, you're just memorizing rules without understanding why they exist. The framework is the architecture behind every IFRS rule. So when IFRS 16 says you must recognize a lease as a right-of-use asset, that decision didn't come from nowhere. It came from the conceptual framework's definition of an asset and the ISB's due process. Understanding the framework means you can reason through any question, even one you've never seen before. The framework tells us 3 things: who sets the standards, how they set them, and in what order you apply them when things get complicated. Think of it like knowing the rules of a game. Once you know who the referee is and what the rulebook says, you can play confidently. International Financial Reporting Standards, IFRS for short, is the global rulebook. Over 140 jurisdictions now require or permit IFRS for publicly listed companies. So when Cathay Pacific or HSBC publish their annual reports, those financial statements follow IFRS. That's why an investor in London can read the same financial statements as one in Hong Kong. Here's the practical payoff. Once you understand the framework, who made a rule and why, you stop just memorizing and start applying. In the exam, that's the difference between getting 2 marks on a familiar MCQ versus getting 6 marks on a scenario question you've never seen. Exam-wise, this topic appears in Section A as straightforward MCQs. Which body does X? And in Sections B and C as discursive marks. Sections B and C often ask you to explain why something is or isn't correct, so conceptual understanding really pays off here. Now let's nail the institutions. Section 2, Key Definitions. I want you to know these so well that if the examiner swaps the names around, you immediately spot the trap. For institutions you must know. Let me walk you through each one and explain what problem it actually solves. The IFRS Foundation. Think of this as the parent company. It handles governance, funding, and strategic direction. It doesn't write the technical rules. Why does this separation exist? To protect the standard setter from political pressure. If a government controls the funding, they could lean on the rule makers to produce standards that favor their industries. The foundation structure prevents that. The International Accounting Standards Board, or ISB. This is the body that actually sits down and writes the standards. It operates inside the foundation, but is technically independent. So when IFRS 16 on leases was issued in 2016, it was the ISB that produced it, not the foundation. The exam loves to swap these two. Remember, foundation governs, ISB develops. The IFRS Interpretations Committee issues what are called IFRIC interpretations. Here's why it exists. Sometimes a standard exists, but a specific real-world situation isn't clearly covered. For example, how do you account for a cloud computing arrangement? Is it a lease or a service? The Interpretations Committee steps in to give official guidance. And crucially, those interpretations carry the same legal weight as a full standard. Due process is the formal procedure the ISB follows before issuing any standard. It goes, research the issue, publish a discussion paper, then an exposure draft for public comment, collect responses, revise, and finally issue the standard. This whole process can take 3 to 5 years. The reason? Transparency and stakeholder input. An exposure draft on insurance contracts was out for years before IFRS 17 was finalized. This matters for the exam. Due process means standards are not rushed out. Now let's look at the documents themselves, the actual outputs of all that governance and due process. IFRS, International Financial Reporting Standards, is a collective term. It covers both the newer IFRS branded standards and the older IS, or International Accounting Standards, that were issued before the ISB was formed. So IS 16 on property, plant, and equipment is just as much part of IFRS as IFRS 15 on revenue. They coexist. Don't assume IS means outdated. Many IS standards are still fully in force. The conceptual framework is the theory document. It defines what an asset is, what a liability is, what makes information useful. Crucially, it is not a standard. So if IFRS 9 says to measure a financial asset at fair value, and the conceptual framework would suggest otherwise, IFRS 9 wins. Always. The framework only fills gaps where no standard addresses a situation. An exposure draft is the ISB's draft proposal for a new or revised standard. At this stage, it has zero authority. You cannot use it to justify an accounting policy. But here's the practical angle. If you're a big company and you see an exposure draft proposing a change to lease accounting, you start planning your systems now. Exposure drafts signal where the ISB is heading, even if they're not binding yet. IFRIC interpretations, issued by the Interpretations Committee, have exactly the same authority as a full standard. That's the key exam point. If an IFRIC interpretation applies to your situation, you must follow it. You can't ignore it just because it's called an interpretation rather than a standard. Same force, same obligation. Section 3. Let's look at the standard that tells you what to do when there's no standard. IAS 8 is your lifeline in a gap situation. IAS 8, Accounting Policies, Changes in Accounting Estimates and Errors, is where the gap-filling hierarchy lives. Paragraphs 10 to 12 say this. If you face a transaction and no IFRS standard directly addresses it, you don't just make up a policy. You follow a strict two-step process. Step 1. Refer to the conceptual framework. Step 2. If the framework doesn't resolve it, you may look at pronouncements from other standard setters, like U.S. Generally Accepted Accounting Principles, or U.S. GAAP, but only if their frameworks are similar to IFRS and their guidance doesn't contradict any existing IFRS. A concrete example, imagine a new type of digital asset emerged and no IFRS covered it yet. Your management would first look at the conceptual framework to determine whether it meets the definition of an asset. If still unclear, they might look at how the U.S. GAAP guidance treats it. But the moment that U.S. GAAP approach conflicts with an existing IFRS principle, you stop and go back to IFRS. Section 4. 5 Core Principles. These are the conceptual pillars behind everything we've covered. Let me walk you through them with real context. 3 Governance and Process Principles first. Let me give you the intuition behind each one. Principle 1. Governance Structure. The IFRS Foundation governs the whole system. It appoints trustees, manages funding, oversees strategy. The ISB sits inside it and does the technical work. Why separate? Because if a government or a large corporation directly controlled the ISB, they could push for standards that favor their interests. The separation is a firewall against political interference. Think of it like a central bank, independent from government, so it can make unpopular decisions when needed. Principle 2. Due process. This is a multi-year journey. The ISB starts with research, gathering evidence, and identifying the problem. Then a discussion paper goes public, followed by an exposure draft with a formal comment period, often 120 days. Then they analyze thousands of responses, revise the draft, and only then issue the final standard. IFRS 17 on insurance contracts took over a decade from first discussion to effective date. Why does this matter for the exam? It means standards aren't issued quickly, and exposure drafts have no authority along the way. Principle 3. Hierarchy of authoritative literature. Picture a pyramid. At the top, Specific IFRS standards, IAS, IFRS, IFRIC. Below that, the conceptual framework. The framework only applies when you climb down to that second level because nothing at the top covers your situation. You cannot use the framework to override what a standard explicitly says. For instance, the framework might suggest an item should be recognized as an asset, but if IFRS 9 says it must be expensed immediately, IFRS 9 wins. Two more principles, now about objectives and real-world adoption. Principle 4. The objective of IFRS. IFRS exists to help investors, lenders, and other creditors make decisions about where to put their money. That's it. It's not designed to calculate tax. That's what tax law is for. It's not there to support government economic policy. So when a company prepares IFRS financial statements, the question they should be asking is, does this information help a shareholder in London decide whether to buy or sell our shares? That investor focus is baked into every standard. Principle 5. Global adoption. Here's a misconception I see constantly. Students assume IFRS is universal. It isn't. Each jurisdiction decides independently. The EU requires IFRS for the consolidated statements of listed companies, but German SMEs can still use German GAAP. The US uses US GAAP, not IFRS. Some countries adopt IFRS with modifications. They call it IFRS as adopted by the EU or their local equivalent. So IFRS is global in ambition, but jurisdiction-specific in practice. The exam sometimes tests this with a question about whether a specific type of entity must use IFRS. Section 5. Application Notes. Let's see how the hierarchy works in a real situation, and then cover a few practical points about adoption and exposure drafts. Imagine your company starts dealing in a brand new type of financial instrument that no existing IFRS covers. How do you decide how to account for it? Let's walk through the steps. Step 1. Under IAS 8. Go straight to the conceptual framework. Does this item meet the definition of an asset? Does it give you a probable future economic benefit you control? If the framework resolves it, you're done. No need to look anywhere else. Step 2. Only if the conceptual framework leaves you genuinely uncertain, you may then look at other standard setters. The most commonly referenced alternative is US GAAP, because the FASB, the US standard setter, uses a similar conceptual basis. So you check how US GAAP handles your instrument and potentially follow that approach. But here's the crucial condition for Step 2. The US GAAP guidance is only usable if it doesn't conflict with any existing IFRS. The moment there's a clash, you discard the US GAAP approach and return to IFRS principles. This is the exam trap. Students sometimes forget this condition and assume you can always use US GAAP as a fallback. You can't, not unconditionally. And don't forget, the conceptual framework is a support tool, not a rule maker. It cannot override a specific IFRS standard. So even if the framework's logic would lead you to a different answer than, say, IFRS 9, you must follow IFRS 9. The framework loses every time there's a direct conflict with a standard. Finally, IFRIC interpretations. Because students sometimes think it's just an interpretation, it's optional. It's not. The moment an IFRIC interpretation is relevant to your situation, it's mandatory, exactly the same force as a full standard. IFRIC 12 on service concession arrangements is a perfect example. It's technically an interpretation, but every PPP project operator must apply it. Now let's look at some practical nuances around governance, adoption, and what exposure drafts actually mean for companies. The IFRS Foundation has a constitution, a formal document that requires it to act in the public interest. This is why trustees come from diverse geographic and professional backgrounds. It prevents any single country or industry from dominating the standard-setting agenda. For the exam, just know, the Foundation's accountability mechanism is its constitution and public interest mandate. Adoption varies massively. Some jurisdictions, like Hong Kong, mandate IFRS essentially verbatim for listed companies through their own HKFRS, which are almost word-for-word identical to IFRS. The EU mandates IFRS for listed consolidated statements, but calls it IFRS as adopted by the EU, because occasionally the EU has delayed or modified a standard. The US, as mentioned, uses US GAAP entirely. So global IFRS is really a patchwork. Exposure drafts, zero authority, full stop. If you're sitting your exam and a question mentions that the IASB has published an exposure draft proposing a new treatment, that proposed treatment is not currently required. However, and this is the practical bit, big companies track exposure drafts because they can start preparing systems and disclosures before the standard kicks in. The IASB published exposure drafts on sustainability reporting years before any standard was finalized. But while exposure drafts have no authority, they're enormously useful signals. If the IASB issues a draft saying, "We plan to require all crypto assets to be measured at fair value," companies holding crypto assets will start planning for that change even though it's not yet law. Smart financial controllers watch exposure drafts closely. And one final point on objectives. IFRS is laser-focused on decision-useful information for investors and lenders. It is explicitly not about computing tax, supporting government economic policy, or aligning with US GAAP. The exam often offers those as tempting but wrong answer options. Keep this front of mind. Section 6. Common pitfalls. These are the mistakes I see students make repeatedly. Let's eliminate them now before you hit the exam. 5 classic traps in this topic. Let me give you the context for each one so they actually stick. Pitfall 1. Confusing the framework with a standard. The conceptual framework is background theory. It cannot override a specific IFRS requirement. If IFRS 16 says recognize a right-of-use asset, you cannot say, but the framework suggests this isn't really an asset, so I'll skip it. The specific standard always wins. Framework fills gaps. It doesn't override rules. Pitfall 2. Mixing up the IFRS Foundation and the IASB. The IFRS Foundation governs, thinks of it as the board of directors. The IASB sets standards, it's the technical team. If an exam question says the IFRS Foundation issued IFRS 15, that's wrong, the IASB issued it. The foundation doesn't write standards. Pitfall 3. Assuming standards are issued quickly. They're not. The due process is deliberately slow. Research, discussion papers, exposure drafts, comment periods, revisions. IFRS 17 took over 20 years from initial identification to final standard. So never say the IASB can quickly issue a standard in response to a crisis. That's not how it works. Pitfall 4. Assuming IFRS is universal. Japan has J-GAAP. The US has US GAAP. Even within IFRS jurisdictions, unlisted companies may use local GAAP. The EU requires IFRS only for listed consolidated statements. So a small private company in Germany might never touch IFRS. Don't overstate IFRS reach. Pitfall 5. Treating exposure drafts as binding. A student might read a question that says, the IASB published an exposure draft requiring X, and think they must account for X that way. You absolutely must not. Until the final standard is issued and its effective date arrives, you follow existing standards, not proposals. Exposure drafts equals intentions, not obligations. Section 7. Quick recap. 5 things to lock in before we hit the practice questions. Let me lock in the 5 key takeaways from this topic, each with a quick memory hook. First, IFRS Foundation governs, IASB develops, separate roles, and that separation is intentional. Foundation is the parent company. IASB is the technical team inside it. Never mix them up in the exam. Second, due process is research, exposure draft, public comment, final standard. Think of it as the democratic process of accounting. Stakeholders get their say before any rule is locked in. It's slow by design. Third, the hierarchy is IFRS standards first, conceptual framework second. The framework only fills gaps. It cannot override. If there's a specific IFRS standard addressing your situation, that's your answer. End of story. Fourth, when no standard exists, IS 8 says use the conceptual framework first, then, and only conditionally. Look at other standard setters like US GAAP, provided there's no conflict with existing IFRS. 2 steps, strict conditions. Fifth, global adoption is not automatic. Each jurisdiction decides independently. The EU, Hong Kong, and Australia broadly follow IFRS for listed companies, but the US uses US GAAP and many countries allow or require local GAAP for non-listed entities. IFRS is the global ambition, jurisdiction-specific in reality. Right, lecture done. Now let's put all of this to the test. We've got 5 MCQs and 2 short answer questions. These are exactly the style you'll see in the real exam, so treat them seriously. And that wraps up topic A3, the regulatory framework. 3 things to carry forward. 1. Know your institution's code. Foundation governs. ISB develops. Interpretations committee interprets. 2. The hierarchy. IFRS standards trump everything. The conceptual framework only fills gaps. 3. IFRS is not universal. Adoption varies by jurisdiction and entity type. Next up is topic A4, governance and stewardship of limited companies, where we look at how companies are structured and how accountability is maintained at board level. See you there.